Most traders lose money, and that's the brutal reality. But here's the thing, most traders also don't understand the right way to trade. This is why you need this video, because you have been trying all wrong. I'm gonna be straight with you. That few $100,000 you threw into Bitcoin, that isn't trading. That's called irrational thinking. By the end of this video, you'll not only understand how to properly analyze charts, but also how to read the market, avoid traps, and make confident trading decisions like the pros. Section 1. Understanding candlestick charts. All right, before you even think about clicking that buy button or entering a trade, you need to understand one thing. The market is a language. And like any language, if you don't know how to read it, you're gonna get wrecked. Most traders lose money. Why? Because they're illiterate in the market terms. They jump in blind, hoping and guessing, praying that price moves in their favor. But the market doesn't give a shit about your hopes or feelings. It speaks in charts. And if you don't understand what those charts are telling you, you're just gambling. So let's fix that. Right here, right now, at its core, a candlestick represents a battle between buyers and sellers within a specific period of time. Think of it as a mini war where bulls, the buyers, and bears, the sellers, just fight it out. Every single candle on the chart is the result of that fight, and it gives us 4 critical pieces of information. 1, our open price, where the price started during that time period. Number 2, the close price, where the price ended. Number 3, the high price, the highest point of it reaching. Number 4, the low price, the lowest point it reached in that time. This is the foundation of reading the market. If you don't understand this, you're not trading. You're just throwing darts at a board blindfolded and hoping for the best. Bullish versus bearish candles, the basics you can't ignore. Now, a green bullish candle means the price closed higher than it opened and tells us the buyers won't battle during that time period. More people were willing to buy at a higher price, pushing the price up. A red bearish candle means the price closed lower than it opened. That means sellers had the upper hand. They dumped more than the buyers could handle, pushing the price down. But if all you do is look at whether a candle is red or green, you're missing the entire fucking point. The real magic, the real edge, comes from understanding the shape of the candle. Because the shape, that tells a story. Once you understand that story, you can start predicting what happens next. And that, my friends, is the closest thing to a goddamn crystal ball that exists in the trading world. Candlestick patterns that predict market moves. Now, let's talk about 3 candles you absolutely need to recognize if you want to stop bleeding money in the market. Number 1, the shooting star. The market is about to dump. Imagine this. The price has been pumping. Everything looks good. Bulls are hyped. Twitter is screaming, and all of a sudden a candle forms that looks like an upside down hammer. Tiny little body with a huge wick on top. This is called a shooting star. And it's a major red flag. Why? Because this candle tells you that price tried to move up, but the sellers just smacked it right back down. And it means there's weakness in the move. It's like fighter throwing the biggest punch and their opponent just eats it like breakfast. So if you see a shooting star at the top of an uptrend, that's your warning sign. The market is about to flip. Bulls are losing stream and sellers are about to take control. The dump is coming. The hammer candle. Buyers are fighting back. Now, let's flip the scenario. Imagine the market's been tanking, red candles everywhere. Everyone's panicking, selling everything like in the world is ending. But then, boom, a new candle forms. It looks like a hammer, tiny little body, huge wick on the bottom. This is called a hammer candle, and it's the opposite of a shooting star. It tells you that the price dropped hard, but now buyers are coming in and said, nah, we're not done yet. This candle is a sign that a reversal may be coming. It means sellers try to drive the price lower, the buyers fall back and pushed it back up before the candle closed. If you see this at the bottom of a downtrend, pay attention, because it could mean the start of a new uptrend. Now, the doji candle, the calm before the storm. All right, last one, and this one's crucial. The doji candle is like the market is holding its breath. The open and close price are basically the same, so the candle looks like a little cross or a plus sign. What does this mean? Indecision. Buyers and sellers are fighting evenly, and the market can't decide which way it wants to go. And guess what? That means a big move is coming. Whenever you see a doji, start paying attention because something is about to happen. Either buyers are about to take over and send price skyrocketing, or sellers are about to rug pull the whole thing and dump it to the ground. Your job? Wait for the confirmation. If the next candle after a doji is a strong green candle, that's bullish, buyers won. If the next candle is a big red one, that's bearish. That means the sellers won. The doji is a signal that a major decision is coming, so be ready to react. Now, none of this really matters unless you understand the next important 4 sections that go more into depth of how this shit actually works. But you got the basics down. You know what a single candlestick means. Whether the market is leaning bullish, bearish, or just confused as hell, here's the truth. One candlestick alone won't make you money. What actually gets you paid? Multi-candlestick patterns. These patterns are like plot twists in the market storyline. They tell you when a trend is about to reverse, when momentum is about to explode, and when a move is just getting started. And trust me, this is the shit that professional traders watch like hawks every day. So let's break down 3 of the most powerful and profitable patterns that can change the game for you. The bull flag pattern. The market is loading up. Imagine you're watching a stock or Forex pair and it starts running. You see these big fat green candles printing, prices pumping, everyone's excited, but then bam, the momentum slows down. Price starts pulling back a little bit. Most new traders, they panic. They see a red candle and think, oh shit, time to sell. Wrong. What they didn't realize was this isn't a dump, it's a setup. This is called a bull flag pattern, and it's one of the most reliable continuation setups in trading. Here's how it works. A strong push up, the flagpole. The green candles, strong momentum, high volume. A small pullback, the actual flag itself. A couple of red candles, but not a full-blown crash. 3, a breakout above the zone. This is your signal to enter and ride the next leg up. This pattern works because after a strong move, traders take profits, but if the asset is still bullish, the buyers step back in and send the price even higher. The key to trading a bull flag: wait for the breakout above the flag before entering. You don't want to buy the dip blindly. Wait for the price to show you strength again. The head and shoulders pattern. The market is about to die. All right, now let's talk about a pattern that sends the market into a f***ing abyss. The head and shoulders. This is a trend reversal pattern, and when you see it, you better start looking for exits because shit's about to get ugly. Here's what it looks like. A first peak, which is your left shoulder. Price runs up and then dips. A second higher peak, that's the head. Price pushes even higher, but then drops again. A third lower peak is the right shoulder. Price tries to rally one last time, but fails to make a new high. Once price breaks the neckline, that's the level connecting the dips between those peaks, and it's game over. The market is about to sell very hard. Why does this happen? Simple. Buyers get exhausted. Imagine you're running a race. You sprint up a hill, left shoulder, you catch your breath, and you push harder to go even higher, the head. But then you start to get tired. You try one more time, the right shoulder, but it's weak as Eventually you collapse, and all that's left is to roll down the hill. Traders who ignore this pattern end up getting wrecked when the market reverses. Professionals, they see it forming and get the hell out, or they short the position and make money on the way down. Last pattern, but this is a gold mine. This is called the ABCD pattern, and it's literally a roadmap to breakouts. If you want to catch explosive moves before they happen, you need to master this one. Here's how it works. A to B, the initial run up. Big green candles, strong moves up. Number 2, B to C, the pullback. The price cools off, some sellers take profits. Number 3, C to D, the next move up. Price holds support at C and then breaks out to new highs. This pattern works because the market moves in waves. Even in an uptrend, you're not going to see straight green candles. However, the market pushes up, cools off, and then it has to rally again. Smart traders spot the ABCD forming, wait for price to hold above the C, and then get in before the next leg up. This works in stocks, Forex, crypto, basically whatever. Human psychology doesn't change, and this pattern shows up everywhere. But none of this matters if you don't know and understand the proper trading techniques and strategies. Section 2, trading and strategies. Now we're getting into the real shit. At this point, you know how to read charts a little bit. You can look at candlesticks, spot market sentiment, recognize patterns, but guess what? None of that means shit unless you know how to trade. Reading a chart is like knowing the rules of a sport. It doesn't make you a champion. The strategy does. And if you don't have strategy, you're just gambling. I'm now going to give you 4 of the most powerful trading strategies that professional traders use on a daily basis. This is how you stop guessing and you start executing. First up, trend trading. Arguably the easiest way to make money in the market. Let's get one thing straight. Trends are your best friend. The market isn't random, it moves in predictable waves. Higher highs and higher lows in an uptrend, lower highs and lower lows in a downtrend. So if price is trending up, you buy the dips. If price is trending down, you sell the dips. Do not fight the trend. Here's what that looks like. Price pushes up higher, high, and then it pulls back slightly, and then you create a higher low. And then it pushes up again, creating a new higher high. You enter on the pullback, not at the peak. Here's where 99% of traders f*** up. They chase price. They see price pumping, FOMO in, and they buy the top. Then boom, price pulls back, they panic sell with a loss. Instead of waiting for the pullback, enter at a strong support level and ride the next wave up. And if you're trading a downtrend, same exact rules apply, just in reverse. Ride the wave, don't fight it. That's how you're gonna win in trend trading. Counter trend trading, catching the turning point. All right, so trend trading is great, but what if you could catch the exact moment a trend is about to die? That's where counter trend trading comes in. Instead of following the trend, you're looking for the exhaustion point, the moment when buyers or sellers get too greedy and the market is ready to snap in the other direction. Think about it like this. The market moves like a rubber band. Stretch it too far in one direction and it snaps back. The same thing happens when price, when it is overextended, it has to correct itself. Here's how you spot a reversal before it happens. Massive price spikes with extreme volume. If something just ran up way too fast, way too soon, it's probably due for a pullback. The reversal candlestick patterns I showed earlier, shooting star, a doji, or a bearish engulfing candle at the top of an uptrend, that's your first warning sign. If price is pushing higher, but the RSI or MACD or TDI is showing weakness, The trend is fake. Get out. Counter trend trading is harder than trend trading because timing is everything. If you're too early, you get steamrolled. If you're too late, you miss the move. But if you nail it, you catch the start of the next big trend while everyone else is still stuck in the past. Number 3, scalping. Death by 1,000 cuts. All right, let's talk about scalping. The strategy for traders who don't have patience for slow plays and just want to move quick and make consistent money. Scalping is all about getting in and out fast. We're talking trades like that last a minute, sometimes less. Here's the game plan. Find a market that's ranging sideways, not trending, just bouncing between support and resistance. Enter at a support, exit at a resistance. Enter at resistance, exit at support. Repeat that process. Now, this isn't about catching big moves. This is about stacking small wins over and over. $20 here, $50 there. It adds up. The key to scalping, tight stop losses. If price moves against you, cut it immediately. Get out. High win rate. You need to be winning more than you're losing. Low spreads and fast execution. If you're trading with slow order fills, you're gonna get. So I recommend scalping on EU because it has the highest volume and the most liquidity at any given time. Scalping is not for everyone. It's fast, stressful, and demands laser focus. But for traders who love action, it's the ultimate dopamine rush. Risk management, how to not blow your account. Now, for the most important part of trading and the part that 90% of traders ignore, risk management. You want to know why most traders fail? Because they have no discipline. They gamble their entire account into a trade, it goes south, and boom, game over. So let's make this real simple for you. Follow these 3 rules and you won't go broke trading. The 1% rule, never risk more than 1% of your account on a single trade. If you have $10,000 in your account, your max risk is $100 per trade. This keeps you from losing everything in one bad trade. Number 2, use a stop loss. Always set a hard stop loss before you enter a trade. Don't hope price comes back. Hope is not a strategy. Number 3, take profits before the market takes them from you. Greedy traders hold too long and they lose everything. Secure your profits, stack your wins, stay in the game. The market doesn't care about your feelings. It doesn't care that you believe in your trade. It will humble you if you allow it to. Your job is to manage risk, stay disciplined, and protect your capital. Because here's the truth. Trading isn't about hitting home runs. It's about staying in the game long enough to keep playing. And the only traders who survive are the ones who master risk management. Now, we're going to dive a little bit into the psychology of trading, but I actually made another video about mastering and fully understanding the psychology of trading. So make sure you go check that one out after this video. Section 3, mastering trader psychology. Listen up, because I'm about to save you years of frustration and thousands of dollars in blown accounts. If you think trading is just about charts and strategies, you're already The real battle isn't against the market, it's against yourself. I've seen traders who knew technical analysis better than anyone, but still lost all their money. Why? Because their emotions ran the show. And let me tell you something, if you can't control your emotions, the market will rip your heart out and stomp on it. So right now, we're gonna talk about the 3 biggest emotional killers in trading. These are the reasons why most people fail. If you don't fix these, you'll never be profitable. Your brain is trying to fuck you over. Fear. Let's start with fear, because this is the emotion that wrecks most traders before they even get started. And I get it, fear is natural. It's your brain trying to protect you. But in trading, fear is your worst enemy. Here's how fear destroys traders. You get into a trade, starts going up, and you panic. Instead of letting it hit your target, you take profits way too earlier. Then what happens? The trade keeps running without you. You sit there watching it 3 times your original profit target, and now you're pissed. That's fear. It's your brain telling you, take the money and run before you lose it all. But here's the thing, trading is about probabilities, not emotions. If you set your stop loss and your take profit levels, you gotta trust them. If your analysis was solid, let the trade play out. Stop micromanaging your own success out of fear. You either take a planned loss or a full win, but cutting a trade short, that's a slow death, which is why we launched Market Memo, so you can journal every trade with ease and catch patterns like a pro. I'll leave that link below for you guys. But let's jump back into the video. Number 2, greed. Your ego will bankrupt you. Fear makes you exit too early. Greed makes you stay in too long. And if you don't learn how to control greed, you'll blow your account. Period. Here's what greed looks like. You're in profit, a solid win, but you want more. You ignore your take profit. You think, this thing is going to the moon. Then boom, the market slaps you. Reversal, and you lose all your profits and some. You had a winning trader and you turned it into a loser. Why? Because you got cocky. Let me tell you something. The market doesn't give a shit about your feelings. It doesn't care that you feel like price will go higher. It doesn't care that you believe it can squeeze more. The market punishes greed 100% of the time. You want to know why the best traders in the world stay rich? Because they take profits when they're supposed to, not when it feels right. When the trade plan says so. So repeat after me, follow the plan. Take your profits. Don't let greed turn a winner into a loser. And now let's talk about the biggest addiction in trading, FOMO, the fear of missing out. The thing that makes grown men throw their rent money into a coin because everyone else is making money. FOMO will destroy you. Here's what happens. You see price skyrocketing. Your brain screams, if I don't get it now, I'm gonna miss it. You FOMO in at the top. Seconds later, market reverses, and you're still holding a bag of shit. Congratulations. You just became the exit liquidity. You know who wins in these situations? The people who bought early. The ones who followed their strategy. The ones who didn't let emotions control them. You don't make money by chasing trades. You make money by planning trades. If you missed it, let it go. There's always another setup. The second you feel FOMO creeping in, take your hands off the keyboard, walk away, take a breath. A missed trade is always better than a lost trade. How to fix your trader psychology. All right, so we've talked about the 3 emotional killers of trading. Fear makes you exit too early. Greed makes you overstay and lose it all. FOMO makes you trace bad trades. Now, let's talk about how to fix because if you don't, you'll never make it as a trader. Here's what you need to do. Number 1, set a trading plan and stick to it. Before you enter a trade, know your entry, your stop loss, your profit target. And once you set those, do not touch it. A trade is either a winner or a loser. There is no, maybe I'll hold it a little longer. Trade the plan or don't trade at all. Number 2, accept that losses are part of the game. Even the best traders in the world only have a 60 to 70% win ratio. That means you lose 30 to 40% of the time and they're still rich as Why? Because they manage risk. Stop taking losses personally. Stop revenge trading like a dumb. Losses are part of the game. Accept it and just move on. Number 3, develop the patience of a sniper. Have you ever seen a sniper in a war movie? They sit there for hours just waiting for the perfect shot. That's how you need to trade. The best traders aren't constantly clicking buttons like crackheads. They wait, they stalk the market, and when the perfect setup comes, that's when they strike. You want to win in trading? Become a sniper, not a machine gunner. If you can master the art of psychology, you will win every time. All right, we've covered a ton of shit in this video. You now know how to read a candlestick chart like a pro. You understand exactly how to spot powerful market patterns before they happen. You've learned how the best traders actually execute their strategies while managing risk. And most importantly, you know how to stop letting your own brain sabotage your trading. But here's the thing. All of this means jack shit if you don't use it. So let's talk about how to take everything we've covered and apply it to real profitable trading. Step 1, start charting every single day. If you're serious about becoming a profitable trader, your charts need to be your Bible. You can't just watch a video, not alone, and say, I've got it. You have to train your eyes to recognize patterns in real time. So here's what I want you to do. Pull up a Forex chart right now. Choose a major currency pair, Euro USD, GBP JPY, whatever you want it to be. Scroll back 1 month and start marking every candlestick pattern that we talked about. Find every hammer, shooting star, doji, the bull flag, the head and shoulders. See them in live action. Because once you start seeing those patterns before they happen, then you're actually ready to trade. And if you don't do this, you're setting yourself up to fail before you even start. Number 2, back test the patterns. So you stop gambling and you start winning. So you found your candlestick patterns. Now, let's take it a step further. The best traders in the world don't just trade off gut feelings. They back test everything. That means you take a strategy and you see if it works over time. Here's how to do that. Take a specific pattern. We'll use the bull flag, for example. Go back 6 months on a Forex pair and find every single bull flag that formed. Track what happened next. Did price actually break out? Did it fall? What percentage of the time did it work out? If the pattern worked 70% of the time, that's a high probability trading setup. If it worked 30% of the time, it's dog. Throw it out. This is how you build confidence in your trades. Because when you've seen a pattern work over and over, you're not guessing anymore. You're actually executing. Number 3, demo trade. Before you risk a single dollar, let me be blunt. If you jump into live trading without practicing, you're an absolute idiot. You wouldn't step into a UFC fight without training, right? So why the fuck would you risk real money without practicing first? This is why you start with a demo account. A demo account lets you trade with fake money, but in real conditions. Test your strategy without losing real money. Fix your mistakes before they actually cost you money. Your goal, trade for at least 50 to 100 demo trades before you go live. Follow your trading plan, no emotional trades, no impulse decisions, track your wins and your losses, and if you're not profitable in the demo, you definitely won't be profitable live. Once you can consistently execute in a demo, then and only then are you ready to go live. And when you do, start small. Trade 0.5% to 1% of your account per trade. Focus on consistency before you focus on making big money. Because let me tell you, slow, consistent profits are what separates the pros from the broke gamblers. Step 4, create a trading plan and actually follow it. By now, you should be seeing a pattern here. Trading is about discipline. If you trade based on emotions, you will lose. But if you trade based on a solid plan, that's how you're gonna make money. Your trading plan should include your strategy, trend trading, counter trend trading, scalping, Pick one, pick anything and master it. Number 2, your entry rules. What conditions are needed to be met before you enter? Number 3, your exit rules. When do you take profits? When do you cut a losing trade? Number 4, risk management. What's your max risk per trade? How do you protect your capital? And once you create your plan, stick to it like your life depends on it. Because in trading, your life does. Not literally, but financially. If you don't follow your plan, you might as well just take your money and light it on fire. But if you do, you'll start making smarter trades, you'll stop making stupid emotional mistakes, and you'll finally start seeing the consistency that turns small traders into 6- and 7-figure traders. All right, so here's my challenge to you. Don't just watch this video, do something with it right now. Pull up your chart, mark every single candlestick pattern we talked about. Then backtest at least one of the strategies, and then start a demo and trade at least 50 trades on it. Build your own trading plan and commit to following it. Because if you do that, you're already ahead of the 90% of traders who never do the work. You'll stop gambling, you'll start executing with confidence, you'll finally start seeing real consistency in your trading. That's all I got for you. Hit that subscribe button, and I'll see you guys in the next one. Love y'all. Peace.